Hello, everyone. Welcome to the Changing Jobs or Retiring in 2022 seminar. I'm Tony Marlette Jr., advisor at Brookside Tax and Financial Group. Before we get started, as always, just a reminder, if you reference this seminar when you call our office, you will receive a strategy session complimentary, including one of the copies of our books on retirement planning and estate planning. We'll have slides throughout the presentation as well, and ways to get into contact with us to book that appointment also. I want to have this seminar live in person eventually. We tried to do so. We ran into some concerns to start this year with COVID, weather, and tax season. So I want to get this information out there. And my goal today really is to help you cut through some of the jargon, go over some options, and review the differences with retirement plans, whether it's you plan on retiring this year or you plan on moving to a new employer and you have questions about what to do with whichever type of plan that you have. Just a little background on me. I've been in financial services since 2005. I've been in roles including insurance, client services, sales support, trading, business development, and the last 7 or 8 now as an advisor. I've been with Brookside since June of 2021. I've really had a lot of experience on the retirement plan side. That's been the bulk of how I've spent my career, with everything else that I've included as well. So there's a lot of things in here that people are not aware of that are really above and beyond the scope of just your normal options. So there's a lot of other things to consider. We take a fiduciary approach to everything. Everything that we recommend for you is always going to be in your best interest. Anything that you have with an employer is always going to be subject to what's known as vesting. You're always vested in your own contributions, and we'll get to a little bit more of what that means in a minute. But your vested balance is what you have access to. Vesting really just refers to the part of your retirement plan that is in fact yours. And you may be saying, well, it's my money. I put money into the account. What does that mean? Basically, yes, you are always vested in your own contributions, but if your employer puts in a match or a profit sharing or any contribution on their end, they can, and they usually do, have stipulations around when you can take that money. Most of the time, it's in terms of years of service. So for example, you work at a company for 5 years. You put in a total of $30,000 of your own money into a 401k plan. The company puts in $20,000 of their money into that plan, but says that you have to be there 6 years to collect all of it. You may have the ability to collect some of it based on your eligibility. You were there 5 years out of the required 6, so they may take back some of it when you leave. So one thing that I think people oftentimes overlook, if you're considering leaving your employer and you're concerned about your retirement options, check on your vesting before you leave, especially if you're close. Maybe you're within a year or two of being 100% fully vested in your company contributions. Be sure to check on that. You don't want to leave any money on the table when it comes to that. Some of you may have pensions available, 401ks, 403bs, thrift savings plans, 457s, simple IRAs, SEP IRAs are kind of becoming a little more prevalent in the workforce nowadays. Companies are starting to do away with pensions. Pensions put all of the risk onto the employer, as opposed to the other accounts that I referenced, which put at least some of the risk onto the employee. So companies are starting to get away from doing pensions, but if you're fortunate enough to have one, a little bit different options apply in those cases. You may have the ability to take it as a lifetime payout, or as a lump sum, and that does not necessarily mean taking all of your cash all at once. It means with the lump sum, you have the ability to move it into your own retirement plan. We can go over a little bit more about that in a bit as well. We're going to mention a lot about tax qualified IRS plans in this presentation. Tax qualified essentially means that the money is qualified or entitled to special benefits from the IRS. So for example, an example of tax qualified is, say, a 401k plan. Any contributions that you put into the 401k generally come on a pre-tax basis. What that means is you get a tax break for any of the money that goes into that account. So you do not pay income taxes on that amount when you put it in. It's a nice benefit at the end of the year. For example, you make $100,000 in salary and you put in $10,000 to a 401k. For tax purposes that year, your income is $90,000. The drawback to that is taxes are inevitable. So you're not going to go without paying them. You probably guessed right, you pay them on the way out. So when you're in retirement or when you take the money out of the 401k in this example, you pay taxes on the money at that time. It essentially gets added on to your income for that year. So tax qualified, again, just means that it's subject to special tax benefits from the IRS. We talked about pensions earlier. A lot of times, if somebody is looking for a steady stream of income payments, annuitizing or taking an income stream from a pension may be the best way for somebody to go. Usually, you will get a higher payout by doing things that way as opposed to taking what they refer to as a lump sum. I mentioned before, a lump sum does not mean give me all my pension and put it into my bank account right now. What a lot of companies that offer the pensions are doing is saying, you can have this paid out to you for the rest of your life if you want to. You'll receive X dollars no matter how long or how short you live, and you may be able to leave some of the money to a beneficiary after you pass away, like a spouse. The lump sum option comes into play when somebody wants a little bit more control. When you annuitize anything or when you take those pension payments, for better or for worse, you have no ability to stop that. So if you're receiving $500 a month from your pension, and that's the option that you elect, they're going to continue paying out that $500 as long as you live. Now that maybe doesn't sound too bad, but if you have a lump sum option, instead of taking that, you can say if that lump sum equates to $400,000, you can say, I'll take my $400,000, put it into a tax qualified account, keep the taxes deferred, continue to earn interest on it, and I'll take it when I want to take it. In the meantime, you're able to invest that in different ways as well. We'll talk about how that works with the account name and registration as well. So again, vesting, very important. Making sure that you're doing your due diligence as far as what you're entitled to, and then understanding any options on the pension if you have those options. The ideal scenario, this has really become kind of few and far between, is if somebody has the ability to take a pension and they have a 401k. In that case, you can really have the best of both worlds. You can obviously have the steady income that the pension generates, and then also the lump sum and the self-directed and the control that the 401k offers as well. So we'll put up a slide now as far as what options you actually have. This will be assuming no pension. This will just be 401k, 403b, thrift savings plan, or 457. We'll go over what all those mean in a second, but those are all tax qualified accounts. The options when you leave your employer are as follows. Now, it's going to take a while before your employer is able to update your status that you're no longer working there. Typically, to exercise any of these options, you need to be off the payroll, received your final paycheck, not receiving any kind of severance, and the company essentially has to let the 401k provider know of that. That can take anywhere from a couple of pay cycles to 6 months, depending on what the agreement is, if you're receiving any severance or anything like that. So these options generally apply after you've left your employer. The only other time they can apply is if you're over age 59 and a half and you're still working. So 59 and a half or older, generally, depending on the plan document, you may or may not be able to have these options as well. So those options are three really main options, and then there's a lot of different ones within those. But first and foremost is the option to defer. Deferring just means that you're really not making a choice. You're leaving the money in the plan, and that's fine. You're able to do that in almost all cases. Drawbacks to that are, you're not able to contribute anymore as a non-active employee. You're limited in some degree to whatever the plan offers as the investment options go. And you could also be assessed costs or fees that are above and beyond what you're used to paying with your 401k since you're not an active employee anymore. Option number 2 is what's known as a direct payout. So generally speaking, if you take the money payable to yourself from your 401k or 457 or 403b or your thrift savings plan, you will pay income taxes on that money. So if you have a $100,000 401k and you say, I need $20,000 to get me through for the next few months, you're going to pay income taxes on that $20,000 if you withdraw it from your 401k. Like we said earlier, tax qualified means you have not paid taxes on that money yet. So the IRS is going to want their share, of course. You owe taxes at that time. If you're under age 59 and a half, how they pick that number, I don't know. But if you're under age 59 and a half, generally speaking, you will pay a 10% early withdrawal penalty. So again, income taxes on any amount that you take out, no matter what. And if you're under age 59 and a half, when you take the money payable to yourself, you owe an additional 10% penalty. Now there's exceptions, of course. So there's a little known concept known as the age 55 rule within any of those plans. The age 55 rule simply says, if you leave your employer in the year that you attain age 55 or later, you do not pay a 10% early withdrawal penalty. However, that's only applicable if the money stays in the plan. So we'll talk about rollovers and Roths going forward here, but just to recap on that age 55 rule, if you leave your employer age 55 or later, take the money out of your 401k payable to yourself, you are still going to owe income taxes. Ordinarily, you would owe a penalty on that money, but if you're 55 or over in the year in which you leave your employer, you do not pay a 10% early withdrawal penalty. So strategically, that's a nice option to have. That's something we use often in financial planning. If we're going to look at sending some money to somebody, we're looking at doing some different options, maybe aligning different buckets. If they're between 55 and 59 and a half, we definitely want to keep that in mind because, again, we'll talk about a rollover as option 3 in a minute, if you do a rollover from a 401k into your own individual account, even though the transfer is not taxed, take the money out of the individual account before 59 and a half. You're going to owe a penalty whether you're 55 or not. So a very important distinction there. Age 55 or older, keep the money in the plan if you think you're going to need it payable to yourself before age 59 and a half. Of these accounts, something that sometimes slips through, a 457 plan is very similar to a 401k where an employee and an employer make the contributions to the account. 457s are generally for government employees. They don't ever have a 10% early withdrawal penalty. So 457 is a nice benefit there. If you're under 59 and a half or significantly under 59 and a half, you lose that privilege, just like the age 55 rule for the 401k, if you take the money out and move it into another account. So the 457 usually does not have a 10% early withdrawal penalty. So that somewhat covers option 2, which is your direct payout. Option 3, probably the most commonly used one, and generally speaking, probably the best of the 3, is what's known as a rollover. A rollover is very simply taking the money from the 401k, moving it into your own individual retirement arrangement or IRA, another tax qualified plan. There are no taxes on the transfer. So for example, you have a $100,000 401k. You don't need the money payable to yourself. You want to continue to invest it. You want to defer it for your retirement, or maybe you have a longer term time frame for it. You take $100,000 from the 401k, move it into your IRA. There are no taxes, no penalties for that. Now, once you remove the money from the IRA, if you take it payable to yourself, you will have taxes and applicable penalties at that time. Penalties are the same, 59 and a half, and there are generally some exceptions. There's 6 or 8 exceptions based on hardship that the IRS accepts for IRA withdrawals to avoid the penalty. But essentially, there's a big difference between taking money out of the 401k and popping it into your bank account versus taking the money out of your retirement plan and putting it into another tax qualified vehicle. Big difference. There's also an option that is kind of a mixture of both, direct payout and a rollover, which is known as a 60-day rollover. So the 60-day rollover is you take some money payable to yourself. You do have 60 days from the date you receive the money to move it into an IRA and not pay the taxes on that money. I've seen this used before for some people who have upcoming large expenses, and maybe they're able to put the money back. So for example, maybe you leave your employer and you want to take a withdrawal from your 401k to put a down payment on a house. So you take the money out, put it into your bank account, and you put the money down on the house. If you replace any of that money within 60 days and put it into an IRA, the amount that you replace is not taxable. It's known as an indirect rollover. So example, $100,000 401k. You leave your job, you take $20,000 out of the 401k. For whatever reason, it doesn't matter. And within 60 days, you put of your own contributions or however you want to fund the IRA, $20,000 or any portion of that $20,000, that amount is not taxable. You have to do it within 60 days. So it's known as a 60-day rollover or an indirect rollover. It's not the ideal way to do things. The direct rollover where you set it up and move the funds from one account to the other is the better way to go. It's more efficient and it leaves lot less margin for error, but I have seen it done in some circumstances, and it can be beneficial. Again, it's just not the preferred method. We've talked about tax qualified accounts and putting money up front to get a tax break and deferring taxes on that money until you withdraw it from the account. So we'll talk about Roth now. Roths are available as IRAs, which is how they started. And they've also become pretty prevalent within 401ks. All a Roth is the opposite of the tax. It's tax qualified, but it's opposite of what we discussed earlier. So remember what we discussed earlier, we call it pre-tax or traditional contributions. When you take money, whether it's from your paycheck or from your bank account, put it into a tax qualified or a traditional or a pre-tax account, you get a tax break. You pay taxes when you withdraw the money. We talked about that. Roth is the exact opposite. You do not get a tax break on Roth money up front. And you could avoid paying taxes on Roth money on the back end. Generally speaking, you'll have taxes on the earnings unless you have the money in the account for 5 years and attainment of age 59 and a half. So an example, instead of putting $20,000 into a 401k in 1 year, maybe you put your $20,000 into your company's Roth option within that 401k. So $20,000 into a Roth 401k, and you have a salary of $100,000 that year. You do not get a tax break on the Roth contributions. So from a tax perspective, your income for that year is still $100,000. Remember before, on the traditional or the pre-tax side, you put in $20,000 and you have a $100,000 salary. For tax purposes, your income is $80,000 for that year. No such benefit with the Roth. The benefit to the Roth comes on the back end. When you go to withdraw the money, the amount that you've put in is not taxable, and the earnings are only taxable if you have not had the account open for 5 years and you are not 59 and a half. So if you start a Roth IRA and you're 22, you fund the Roth, and at age 60, you go to withdraw it. Under most circumstances, that Roth IRA, not a penny of it, is going to be taxable, which is a great benefit. You've accumulated the money all those years, you've deferred taxes, and now since you've had the money in the account for 5 years and you're over 59 and a half, none of it is taxable. 401ks have been incorporating Roth contributions into them as well. They started off as IRAs only, and they really do have big benefits for people. So we'll take a look at the slides that are on the screen now. We talked about the 3 different options, and remember, an IRA and a Roth are just accounts. They are not investments. They are not vehicles that by themselves are going to generate you rates of return. The nice thing about an IRA and a Roth, for that matter, is the account characteristics are determined by how you put the money in. So for example, we mentioned the differences between the IRA and the Roth. You can fund an IRA or a Roth IRA with just about anything. If you wanted to use a CD, if you wanted to use a stock, a mutual fund, an annuity, whatever it may be, that determines your rate of return within the IRA or the Roth. So for example, you can have Apple stock, you can have it in an IRA, you can have it in a Roth IRA. It's going to generate you the same return one way or the other. The only difference is, because it's got the IRA or the Roth IRA coding, how you pay the taxes and really when you pay the taxes. So the investment vehicle goes in the Roth or the IRA. The account itself, the IRA or the type, is just the registration or the coding for the taxes. So moving on, we talk about market risk, and really there's different types of risk that are all over the place. The one that people most affiliate when they talk about investing is going to be market risk. So one thing that we can do with market risk to alleviate it is to diversify. When we talk about diversifying, when we talk about essentially including different investments within an account or an overall strategy and allocating those assets or allocating those funds in different ways. You're also able to take advantage of taxes by doing what's known as a Roth conversion. So a Roth conversion will allow you to take pre-tax money from, say, an IRA or a 401k, moving it into a Roth IRA and getting the taxes out of the way now. We see this, it's very common nowadays. Our taxes are probably about as low as they're going to be in a very long time. The current tax laws are set to expire in 2025. So really over the course of the next 3-4 years or so, we're going to see money flow from IRAs to Roth IRAs to get the tax burden out of the way now while taxes are relatively low. And here's what I mean. We see a lot of this with people with large IRA and 401k pre-tax balances built up. If you don't plan on taking this money out, say, for example, when the tax cuts that were enacted in 2017 expire in and around 2025, if you don't plan on taking money out until then, you're probably going to be paying a lot higher tax rate than you would if you took the money out now. Somebody might say, well, I don't need to take the money out now. I want it to continue to grow. That's where the Roth conversion can really be a benefit. Essentially, you take IRA or pre-tax money, move it to Roth, it's taxable then. So for example, if you wanted to get the taxes out of the way this year, when taxes are going to be lower than they're going to be in the future, you don't have to do the full balance. You can, break off a portion of it, move it to the Roth, get the taxes out of the way. A Roth conversion is not penalized. So you do pay taxes. That's the idea though. And then anything that you move into the Roth, as long as you have it 5 years and you're 59 and a half, comes out tax-free. We've been seeing this. I know we've been recommending it to certain clients in certain situations that can benefit from it because people are looking for ways to get taxes out of the way now. Tax planning is about as big a part of financial planning as anything. If we look at the next slide, we talk a lot about required minimum distributions, or RMDs. These are going to be required for every retirement account that we've mentioned. The exception is the Roth IRA. So what is a required minimum distribution? Very simply, when you have tax qualified money that you have not paid taxes on yet, the IRS wants that money. They want you to take the money out so they can tax it. So what they want to avoid is people taking tax money and deferring it over extreme periods of time. So what they're going to say in any of those accounts, except a Roth IRA, is you got to take the money out. It's age 72. They moved it up from 70 and a half to age 72 back during the Secure Act of 2019. And all it says is, based on your life expectancy and your account balance from the previous year, we're going to run a formula, run a calculation, and tell you how much you have to take out. If you have a Roth IRA, you have no such problems. Roth IRAs, they're not interested in required minimum distributions. Why not? Because in most cases, Roth IRAs are not taxable. And in a lot of cases, they're not taxable. In some cases, if they are, only the earnings are taxable. And again, even that's rare if you get to required minimum distribution age. Roth 401ks are required to take required minimum distributions, believe it or not. So that's one big difference between a Roth 401k and a Roth IRA, no required minimum distributions. Our next slide talks about the different types of IRAs. So there's also what's known as a SEP IRA and a simple IRA. These are usually left to smaller employers, and a lot of times you can make larger contributions than you can to a regular IRA. Everything has contribution limits. So a 401k, for example, is going to have a larger contribution maximum per year than an IRA. A simple IRA and a SEP IRA are going to have generally larger contributions allowed than your traditional IRA that you're going to fund. The good thing too is anytime you or your employer fund a SEP or a simple IRA, those contributions do not count towards funding a traditional or a Roth IRA. Traditional IRA, Roth IRA are generally not affiliated with employers. SEP IRAs and simple IRAs are. So a SEP IRA and a simple IRA, you have to have an employer plan to contribute to those. They have certain benefits, and again, they're more advantageous generally for smaller companies. Options for the SEP and the simple IRA, there's a 2-year waiting period for a simple IRA where you establish the account, you have to wait 2 years before you can move it no matter what. So if you establish a simple IRA, leave your company after 6 months, unless you are going to move it to another simple IRA, you have to keep the money in that simple for the remainder of the 2-year period. If you don't, there's a 25% penalty for that. So that can definitely add up. One thing, it's really not pertinent to retirement plan options, but it's relevant to this conversation. You always want to have emergency reserves. Before you start funding any retirement account, or at least while you're funding a retirement account, you need to build up emergency savings that are going to be accessible to you in the event of an emergency. So you don't have to, wait on your employer updating your status so you can take your 401k money payable to yourself when you leave your employer. You don't want to get into situations like that because, frankly, a lot of that, if not all of it, is out of your control. So if we look at our next slide here, we are going to look at what do you actually lose by doing a rollover. So we talked about the rollover being taking the money out of the retirement plan, moving it into something else. Well, for one, you lose the benefit, if this applies to you, of the age 55 rule. So the age 55 rule only applies if you keep the money in your company-sponsored 401k plan. If you move it to the IRA, you do not get the benefit of the age 55 rule. One other thing that you're losing by doing a rollover, you have unlimited protection in a 401k from creditors. Now, IRAs are protected at least for $1 million from creditors. So if you don't have $1 million, you're protected one way or the other. And then each of them, a 401k and an IRA, are considered countable assets for Medicaid unless they're in payout. Any asset that's in payout generally is not a countable asset for Medicaid. The last thing really that you're not even really losing this, but any kind of match, any profit sharing or automatic payroll deductions, you don't have the ability to do in any other account besides what's with your employer. But if you're no longer employed with them, it doesn't matter anyway because they're not matching you. you're not putting money in, and they're not going to provide a profit sharing for former employees. One thing people commonly ask, if you're 59 and a half and you're still working, generally you do have the ability to do a rollover like we talked about before. If you decide to do that, you will not be kicked out of your company plan or anything like that. You're still able to make contributions to your plan, and you're still able to receive a match or a profit sharing. You're not restricted from doing any of those things just because you do a rollover. So again, you want to do a rollover from your employer plan. If you're still working there and you're 59 and a half, generally you're allowed to do so. It does not affect your ability to contribute to the plan or collect any kind of company match. What do you gain from doing a rollover? So we talked about what you lose. What do you gain? Well, I mentioned the 3 F's: freedom, flexibility, and in our case, fiduciary. So the freedom really means your own individual strategy, your own withdrawal schedule can be done when you take the money out of the employer plan, move it into your IRA. You get complete control and autonomy once you put the money in there. Flexibility really just means any investment can be purchased within an IRA or a Roth. We mentioned before Apple stock. You can buy Apple stock within your IRA. You can buy mutual funds, ETFs. You and your advisor, if you work with one, can put together a strategy for you and combine it all within IRA, combining different buckets and different strategies. It's much easier for consolidation as well. 401ks are great accumulation vehicles, but they're not so great for consolidation. IRAs are built for consolidation. Generally, you can do the rollover of the same funds once in a 12-month period. And we also mentioned fiduciary. So at Brookside, we are fiduciaries, meaning we are required to work in your best interest. Oftentimes, things that we've done for people, we can go a little bit more with an unconventional approach in an IRA, whereas with the 401k, you're generally limited to the investment menu within the plan that the company establishes. We look across your whole financial picture as well to help you achieve your overall financial goals. When you take the money, move it into an IRA, we develop an income plan, coordinate that with taxes, Social Security, all those things, and we're able to divide the assets up into, say, maybe a longer term, a little bit more growth-oriented approach versus maybe a shorter-term income-oriented approach. In closing, we partner with Gradient Investments as our money manager, and we work with many reputable insurance carriers and annuity providers to provide those solutions to you. So again, my hope here is that we were able to educate you on what those options are. Everybody's situation is going to be different, right? So no 2 people who come in the door are going to be looking for the same exact thing, nor are we going to do the same exact thing for any 2 people that we meet with. So we take your situation very seriously. We want to take that fiduciary approach. We want to make sure we're working with you to do what's in your best interest. And we really spell that out for you with a comprehensive financial plan. And one thing I like that we can do, we can get our insurance and our annuity carriers involved in this as well. So this is not just us, picking stocks and putting some in cash and different things like that. We want to take an approach where we are looking at every option at our disposal. Again, I'm Tony Marlette Jr., advisor at Brookside. If you visit our site, you come in, you give us a call, schedule that strategy session. It's complimentary if you reference this video, and then also pick up one of our books. So let me know if you have any questions, call our office. And again, I hope to get out and do this seminar live in person later on this year. Thank you for viewing this. And again, let us know if you have any questions. I look forward to talking with everybody soon. Thank you.